Welcome back to Investing Talk podcast.
Good to be here.
Today, we're doing something a little different. You've sent us a collection of information. We've got a due diligence report, some recent news snippets, a company overview, all focused on one company, Yelp.
That's right.
And our goal here is to kind of sift through it all, pull out the key insights, and give you a really clear picture of what's happening with Yelp right now. This is basically your personalized analysis based on what you provided.
Okay, sounds good. Where should we begin? The financials.
Yeah, let's start with the money. The info you sent shows 2024 net revenue hit a record $1.41 billion, which is, no, not bad at all.
Not bad is an understatement. And the guidance for 2025 suggests more growth is expected. They're projecting $1.47 to $1.485 billion.
So that's what, about a 4 to 5% year-over-year bump?
Roughly, yes. But what's maybe even more interesting is the trend leading up to that.
You mean the services revenue? I saw that 15 straight quarters leading up to the end of 24 with double-digit growth there.
That's the one. And total revenue climbing, too, quite significantly. From about $1.03 billion in 2020 up to that $1.41 billion in 2024.
That's like a 37% increase over just 4 years. So what's really fueling that consistent services growth? That seems key.
It really does. Now, the documents don't break down every single service, but there's a lot of talk about AI-enhanced service matching tools.
Ah, okay.
And also their expansion into areas like home services, even healthcare. So it seems likely those are big drivers connecting users to service providers more effectively.
Makes sense. People always need home services. Okay, what about profitability? Net income looks strong, too.
Very strong. It rose significantly in 2024, hitting $133 million. That's a 34% jump from the year before.
Wow. Okay. We don't have the exact earnings per share number here. Obviously, you'd need the official SEC filings for that.
Correct.
But just ballpark, if they have around, say, 70 million shares out, that could put EPS maybe around $1.90 for 2024. Just a rough estimate.
That sounds like a reasonable back-of-the-envelope calculation, yes. The official number would confirm it, but the key takeaway is the significant jump in profit.
And what does that big jump in net income really mean for them? Does it position them better for, I don't know, future growth or maybe weathering challenges?
Oh, absolutely.
Right.
More profit means more financial flexibility. They can reinvest more in R&D, maybe look at acquisitions, or just have a stronger cushion if the economy gets rough. It signals better efficiency, too.
Got it. Now, PE ratio. Again, no exact EPS, so no precise PE here. But you mentioned comparing them to companies like Angie or TripAdvisor. Their average PE is in the 25 to 30 range.
Yes, it's a rough benchmark. Those companies operate in similar sort of online marketplace spaces, connecting consumers with services or travel.
But it's not a perfect comparison.
No, not perfect. Their business models aren't identical. Yelp, for instance, has a really strong local advertising component that's maybe different from the others. So the PE range gives context, a general idea of sector sentiment, but you'd need a deeper dive for a true valuation.
Okay, that's helpful context. Now, debt. It seems like there wasn't any mention of debt in these recent announcements.
No, nothing significant mentioned, which, given their cash flow, suggests their debt level is probably quite low, maybe negligible.
Again, the balance sheet in the SEC filings would tell the full story.
Of course.
But what are the advantages for a company like Yelp having little to no debt right now?
Well, it reduces financial risk. Simple as that. Gives them more freedom to pursue opportunities without worrying about lenders. Lower interest payments boost the bottom line, too. In today's, let's say, uncertain climate, a clean balance sheet is a big plus.
Right. Okay, moving to cash flow. No specific free cash flow number stated, but adjusted EBITDA hit a record $358 million in 2024. That's up 8%.
Mm-hmm.
Can you just briefly explain for our listener what adjusted EBITDA tells us and why it's useful here?
Sure. Adjusted EBITDA, it stands for earnings before interest, taxes, depreciation, and amortization. Basically, it strips out some non-cash expenses and financing costs to give you a clearer view of the cash being generated by the core operations.
So it's a measure of operational cash generation?
Pretty much, yeah. And seeing it rise 8% strongly suggests their operations are becoming more efficient and generating more cash. Based on that and past data, estimating free cash flow somewhere in the maybe $250 to $300 million range feels plausible.
Okay. And the last financial bit, return on equity. Probably improved with that net income jump, assuming the equity base was fairly stable.
Logically, yes.
Yeah.
But again, you'd need the full financials for the exact calculation.
So wrapping up the financials, it seems like Yelp's on a pretty positive path. Healthy growth, improving profitability, strong cash generation, low debt.
Based on this information, that's the picture, yes. But financials are only part of the story.
Absolutely. Let's talk about the business itself, that community-driven review system. That's got to be a huge asset, right? The network effect.
It's fundamental. The more people use Yelp, leave reviews, add photos, the more valuable it becomes for everyone else looking for local businesses.
Right.
That creates kind of moat, a barrier that's hard for competitors to overcome quickly.
Yeah, that makes sense. And they're not just resting on that, are they? They're pushing hard on AI. You mentioned over 80 product updates in 2024.
80 updates, yes. A lot focused on AI, like those service matching tools we talked about. Plus, they've been around since 2004. That's nearly 2 decades of brand recognition in the local space.
That's true. So, market position. They're definitely a leader in crowdsourced local reviews, but it's crowded, as you said. Google Reviews is massive. Then you have niche players like HomeAdvisor, Angie.
Exactly. They face competition from multiple angles. The giants like Google have sheer scale and integration advantages. The niche players can offer deeper specialization in certain categories, like home services.
So, what are Yelp's specific advantages against those? Or where are they maybe more vulnerable?
Well, their advantage is that deep focus on local and the richness of their review content built over years. They have a dedicated community. The vulnerability. Competing with Google's default presence everywhere is tough, and staying ahead of niche players requires constant innovation.
Which brings us back to that services segment growth. That seems to be their engine right now, that double-digit streak.
It really looks like it. And it aligns with the broader trend of people using digital tools, especially AI, to find services.
But there are headwinds too, right? You mentioned regulatory concerns, authenticity of reviews, data privacy.
Yes, that's an ongoing issue for the whole online review space. Regulators like the FTC, even state bodies, are looking closely at fake reviews, how platforms handle them, and how user data is protected.
What kind of impact could new regulations have?
It could mean stricter rules on collecting and displaying reviews, maybe requiring more verification. It could also mean higher costs for compliance, investing in tech to fight fake reviews, and ensuring data privacy standards are met. It's something they definitely have to navigate carefully.
Okay. On the positive side, though, the pandemic seemed to push more small businesses online, right? And Yelp's move into home services and healthcare. Those seem like big potential growth areas.
They absolutely are. The pandemic accelerated digital adoption for sure. And home services and healthcare are huge markets. Tapping into those diversifies Yelp's revenue beyond just restaurants and retail ads. It could be a very significant long-term driver if they execute well.
Interesting. Let's talk leadership for a moment. CEO Jeremy Stoppelman. He's been there since the beginning, co-founded it back in 2004, led them through the IPO in 2012, and now the shift towards services. Is there value in that kind of long-term founder-led leadership, especially in tech?
Oh, there definitely can be. It provides stability, a deep, innate understanding of the business and its culture, and usually a consistent long-term vision. In a fast-changing tech market, that kind of steady hand and experience can be really valuable for navigating shifts and challenges. Stoppelman's tenure likely brings that continuity.
And they're clearly not standing still. You mentioned new products like Yelp Assistant, the Yelp Fusion AI API, aiming to get their content onto other platforms.
Yeah, that API strategy is interesting. It essentially lets other apps or websites tap into Yelp's data, the reviews, the business info using natural language search.
So it extends their reach beyond just Yelp.com or the Yelp app.
Exactly. It makes their data more ubiquitous, potentially creating new revenue streams and cementing their role as a key source of local info across the web, not just on their own properties.
But again, it comes back to competition. That space is fierce. How do they keep differentiating themselves, keep holding on to their market share against the big guys and the specialists?
It's likely a mix of things. Doubling down on the quality and authenticity of their community reviews, making their AI tools genuinely useful and better than competitors, successfully expanding into those new service verticals we talked about. It requires constant innovation and really listening to what users and businesses need.
And that authenticity point is critical. There are consumer surveys suggesting people really value genuine reviews over, say, AI-generated summaries. That must influence how Yelp develops its AI, right?
It absolutely should. Finding that balance, using AI to enhance discovery and matching, but not sacrificing the trust that comes from real user experiences, that's crucial. Users need to feel the reviews are credible.
And then there are broader economic factors. If there's a downturn, does that hurt demand for local services and thus hurt Yelp?
It certainly could impact advertising spend from local businesses, yes. Consumer spending might tighten. However, Yelp's platform isn't just ads anymore.
Ah, the transactional services you mentioned earlier.
Right, things like commission-based bookings, maybe direct ordering or, quote, requests. Even if ad budgets shrink, people still need local services. Maybe even look for more cost-effective options. If Yelp facilitates those transactions, they can still generate revenue. That diversification could provide some resilience.
Okay, so let's try to pull this all together. Based on the information you shared with us, Yelp appears to be, well, a company with a pretty strong foundation. Consistent revenue growth, especially in services, improving profits. They're investing heavily in AI and innovation.
Yes, operating in a market that's competitive, definitely, but also large and arguably growing, especially with digital adoption.
And that upcoming earnings report, May 8th, they announced for Q1 2025. That will be a key data point for investors to watch.
For sure. It'll show if that Q4 momentum carried through.
So for you, the listener, looking at all this, what really stands out? Is it that strong, consistent services revenue growth? What does that signal? Or maybe it's the big push into AI. How might that reshape things for them? Or is it simply navigating that really tough competitive landscape?
Lots to think about there.
And here's maybe a final thought to leave you with. We're seeing AI get more and more sophisticated. There's this whole debate about AI and content creation, about trust. How does Yelp manage that? How might their strategy evolve balancing powerful AI tools with the core value of user-generated, presumably authentic content? What does that mean for their competitive edge and user trust down the road?
That's a really central question for them going forward.
Definitely something to ponder. We hope this breakdown of the information you provided on Yelp has given you a clearer picture. Remember, keep an eye out for those earnings on May 8th.
And if you found this tailored analysis helpful, well, we'd appreciate it if you'd subscribe, like, and maybe leave a comment.
We always value your feedback and any suggestions you might have for future analyses. Thanks for tuning in.